In Asia's financial heart, where tradition meets innovation and the city pulses with global ambition, two names have stood the test of time: HSBC and Hang Seng Bank. Together, HSBC and Hang Seng Bank have long been pillars of Hong Kong's banking industry, shaping the city's economic destiny and supporting generations of businesses and families. HSBC, founded in 1865, is a global giant with deep roots in Hong Kong, its legacy woven into the very fabric of the city's rise as a financial powerhouse. Meanwhile, Hang Seng, established in 1933, has grown from humble beginnings into a trusted local institution, serving millions of Hong Kongers with a distinctly local touch and deep community ties. Their relationship is not rivalry, but partnership. HSBC holds a 63.5% stake in Hang Seng, allowing both to thrive. This unique alliance has fostered stability, innovation, and mutual growth for decades. HSBC brings global reach, international expertise, and a vast network that connects Hong Kong to the world's major markets. Hang Seng delivers local expertise, a deep understanding of Hong Kong's unique culture, and a personal approach to banking that resonates with the community. This synergy has created a powerful duopoly in Hong Kong's dynamic financial center, balancing international ambition with local trust and reliability. Now, as we approach December 15, 2025, that partnership is set for a dramatic shift, one that could redefine the future of banking in the region. HSBC is moving to acquire all remaining Hang Seng shares, aiming to make it a wholly owned subsidiary. This marks a bold new chapter in their shared story. This bold move will consolidate power, streamline operations, and enable both banks to respond more quickly to the fast-changing demands of the Asian market. By uniting their strengths, HSBC and Hang Seng are doubling down on Asia's future, positioning themselves to lead in innovation, digital transformation, and sustainable growth. The landscape of Hong Kong banking is about to change forever, as this historic partnership evolves to meet the challenges and opportunities of a new era. Let's explore what's driving this historic transformation and what it means for Hong Kong, Asia, and the world. Hang Seng Bank, one of Hong Kong's most prominent financial institutions, is currently navigating a storm of challenges stemming from the troubled property sector in both Hong Kong and mainland China. The bank, long considered a pillar of stability in the region, now finds itself at the center of a crisis that is shaking investor confidence and raising questions about its future direction. A significant portion of Hang Seng's loan portfolio is deeply intertwined with real estate. As property developers across China and Hong Kong face mounting debt burdens and increasingly strict government regulations, the risk to Hang Seng's balance sheet grows. The bank's exposure means that any downturn in the property market could have a direct and substantial impact on its financial health, making it especially vulnerable in these uncertain times. The situation is further complicated by the looming surge in bond maturities for Chinese property developers, which are projected to jump by 70% in 2026. This sharp increase raises the specter of widespread defaults, threatening to send shockwaves through the entire banking sector and potentially triggering a broader financial crisis. For Hang Seng, this exposure is more than just a financial headache. It poses a real threat to the bank's profitability and long-term stability. Investors are growing increasingly anxious, watching the bank's stock price fluctuate and worrying about the impact on future earnings. The prospect of larger provisions for loan losses is now a pressing concern, as management faces mounting pressure to shore up the bank's defenses and reassure stakeholders that Hang Seng can weather the storm. In response, HSBC, Hang Seng's parent company, has unveiled a bold plan to take Hang Seng private. This move is designed to shield the bank from the volatility of public markets, allowing its leadership to focus on making tough, long-term decisions without the constant scrutiny of shareholders. As a private entity, Hang Seng would gain the flexibility to restructure its operations, manage risks more effectively, and pursue strategic changes with the full backing and resources of its global parent, HSBC. Understanding this context is essential to grasping the significance of HSBC's bold move, a decision that could reshape the future of banking in Hong Kong and beyond. HSBC's $13.6 billion all-cash offer to buy out Hang Seng's remaining shares is a classic take-private deal. If successful, Hang Seng will be delisted and become a private subsidiary, owned entirely by HSBC. The offer, HK 155 per share, gives minority shareholders a clear premium exit in uncertain times. The deal will proceed via a scheme of arrangement, requiring majority shareholder and court approval. This ensures all shareholders are treated equally, and the process is orderly. Full ownership lets HSBC integrate operations, align strategies, and eliminate the costs of a separate public listing. The goal transforms Hang Seng from a semi-independent partner into a fully unified part of HSBC's global family. The mechanics are clear, but the implications are even bigger. A key step in any buyout is the independent board committee's verdict. On December 15, 2025, Hang Seng's committee endorsed HSBC's offer as fair and reasonable for minority shareholders. The HKU 155 per share offer locks in substantial gains. Hang Seng stock is up over 60% this year. The committee weighed the certainty of cash now against the risks of staying exposed to the troubled property market. Their recommendation paves the way for shareholder approval, providing a strong signal that the deal is in investors' best interests. With this endorsement, the path to transformation is wide open. The final decision now rests with shareholders. With the board's endorsement, the buyout moves to execution. On January 8, 2026, minority shareholders will vote on the offer. If approved, a court hearing on January 23 will ensure all legal protocols are met. The deal is expected to close on January 26, with Hang Seng delisted the next day. HSBC will then own 100% of Hang Seng, marking a new era for both banks. On February 25, HSBC will reveal its full-year results and outline its vision for the newly integrated Hang Seng. These dates will shape the future of Hong Kong banking. The countdown to transformation has begun. This deal's impact will ripple across Hong Kong, touching not just the financial sector, but the daily lives of people and the city's global standing. The buyout is more than a simple transaction. It's a turning point that will shape the future of Hong Kong's economy and its role in the world. For customers, immediate changes will be subtle. Hang Seng's brand and branches will remain, but integration with HSBC's global network will bring new benefits over time. Over the coming months, customers can expect to see enhanced digital services, more seamless cross-border transactions, and access to a wider range of financial products. The familiar faces at their local branches will still be there, but behind the scenes, technology and expertise from HSBC's international operations will gradually improve the banking experience. Customers may gain easier access to international banking and investment products, unlocking new opportunities. Whether it's sending money abroad, investing in overseas markets, or managing wealth across borders, the integration promises to make these services more accessible and efficient for everyone, from young professionals to retirees planning for the future. For employees, some back-office consolidation may occur, but frontline jobs and career paths within the HSBC group are likely to expand. Staff will have new opportunities for training, international assignments, and career growth within a much larger organization. While change can bring uncertainty, HSBC's commitment to Hong Kong means investing in its people and their professional development. Investors get a lucrative exit at a premium, while the market sees HSBC's deep commitment to Hong Kong and Asia. The buyout sends a strong signal to global investors that Hong Kong remains a vital financial hub, and that major institutions are willing to invest heavily in its future. The move signals confidence in the region's future, even amid economic uncertainty. It's a vote of trust in Hong Kong's resilience, its talent pool, and its ability to adapt to changing global dynamics. For the city's business community, this is a moment of renewed optimism. By taking Hang Seng private, HSBC is betting on long-term value and resilience. The move allows for more agile decision-making and the ability to invest in innovation without the pressures of public markets. It's a strategic step designed to strengthen both brands and ensure they remain at the forefront of banking in Asia. The effects will be felt by customers, employees, and the entire financial sector. As the integration unfolds, it will set new standards for service, technology, and global connectivity in Hong Kong's banking landscape. This is more than a deal. It's a statement of intent, a bold move that reaffirms Hong Kong's place as a leading financial center and sets the stage for a new era of growth and innovation. HSBC's buyout is the centerpiece of its pivot to Asia strategy. The bank is shifting capital and focus to its most promising growth markets, moving beyond rhetoric to action. By taking Hang Seng private, HSBC simplifies its structure, eliminates inefficiencies, and creates a more agile organization. This integration allows for unified strategy and faster decision-making across Greater China and beyond. Full ownership lets HSBC steer Hang Seng through property market turmoil without public market pressures. The deal strengthens HSBC's foundation in Hong Kong, making it a more formidable competitor. As the world's economic center shifts east, HSBC is positioning itself at the heart of the action. This is about control, future-proofing, and seizing Asia's growth. The stakes and the rewards are enormous. A $13.6 billion all-cash deal is a massive financial undertaking for HSBC. The acquisition will temporarily lower HSBC's capital reserves, pushing its CET1 ratio below target. To rebuild buffers, HSBC will pause share buybacks for 3 quarters and retain more earnings. The biggest risk: full exposure to Hong Kong and China's fragile property markets. If defaults rise, HSBC alone bears the losses. The bank is betting that full integration will help manage these risks better than a public partnership. It's a calculated gamble, balancing long-term Asian growth against short-term financial strain. The world will be watching to see if this bold wager pays off. HSBC's buyout of Hang Seng marks a new era for Hong Kong's financial landscape. For customers, the familiar Hang Seng brand will remain, but services will be enhanced by HSBC's global reach. The integration could offer seamless access to international banking and wealth management, creating a best-of-both-worlds experience. For the industry, this is a seismic shift, consolidating power and forcing competitors to adapt. The deal reaffirms Hong Kong's status as a premier financial center and signals HSBC's confidence in the region's future. By taking Hang Seng private, HSBC is doubling down on its home turf. This move will reshape competition and redefine banking for millions. It's a pivotal moment in the financial history of one of the world's most vibrant cities.